The big news that emerged at the start of this month was the downgrade of US sovereign debt. Credit rating agency S&P downgraded the debt from AAA to AA+. The historic decision was the first of its kind for the US, and has ended up having a spillover effect for other nations, raising doubts about their own credit ratings. Also in the headlines is the ongoing debt distress in the Eurozone. As a result of these two major stories, financial markets are again in turmoil, and most notably, share markets around the globe have been very volatile. The downgrade of US Treasury debt to AA+ still suggests that the chances of a US debt remain vanishingly small, but they are now fractionally bigger than they were. However, the equity market response to this does seem to be disproportionate, and other markets, such as the bond and FX markets, have not reacted nearly so violently. The US debt downgrade comes against the backdrop of a $2.1 trillion deficit reducing agreement. That'll take place over the next 10 years, but falling well short of the $4 trillion grand bargain that S&P had suggested would be necessary to stabilise the US debt to GDP ratio. However, the economic impact of this downgrade, aside from any knock-on to consumer confidence and spending stemming from equity weakness, should be minimal. US Treasuries continue to be accepted as top-notch collateral for banks needing liquidity, and so there should be virtually no impact in terms of lending or investment. So in the short term, there seems to be little likelihood of any remedial policy action, though hope does spring eternal, as often does disappointment. So far, comments from the G7 and G20, whilst offering some encouragement, don't seem to be offering any tangible help. ING's global economics team has revised down forecasts for US growth for this year and next, but this is predominantly because of historical revisions showing that the US recession was far sharper and the recovery far weaker than previous published figures had indicated, rather than any particular weakness in recent data. We had been looking for growth of 2.1% this year and 2.3% in 2012, but with the revised forecasts we now look for growth of only 1.7% this year, keeping 2.3% again in 2012. Now this is right at or even below the bottom of published consensus ranges for GDP growth. We've also pushed back our expectations for the first Fed rate hike, in line with the Fed's latest commitment to keep rates low until at least mid-2013. Meanwhile in Europe, the debt crisis still rages, despite the ECB, the European Central Bank, entering secondary markets to stabilise rising yields on Spanish and Italian government bonds. Fears continue to linger about the size and scope of existing European bailout mechanisms, given the widening remit and need for intervention in markets. For now, we still expect the ECB to remain in tightening mode, but with no further interest rate moves from them until next year, and this view remains subject to downward revision. So with very little chance of a definitive solution to the Eurozone debt crisis near term, we expect to be commenting on this issue for some months to come.